I believe everybody should be in the room. Thank you guys, everyone, for joining our webinar that we are doing today. The topic for today is going to be interest rates and what the current environment is and how they're calculated specifically for the ExxonMobil pension plan. A little bit of information for all of you is that there is a question and answer box that you should be able to have, or a chat box. I'll be checking that as we go through the webinar today. So if you have any questions, please feel free to put those there in that question and answer box, and I will address those as I potentially see those, or at the end of the seminar as well. So let's get started here. There we have a new QR code here that you are welcome to scan. This will take you directly to our website to be able to earmark that for any questions or things that you might have that you want to follow up on as well. Again, my name is Misty Garza. I'm one of the financial advisors here at Bogart Wealth. If you are not familiar with Bogart, if this is your first time joining one of our webinars, I'll give you a little bit of background on some of our team members here. So we have our executive leadership team here that has James Bogart, Jeff Herman as our president, and all of our corporate office as well. We have a full advisory team here across our different offices. We are all registered certified financial planners as well to help you with everything that you're working on. We have our portfolio management team as well, that we manage everything in-house, and we do all of our financial planning in-house as well. And of course, all of our HR and marketing and teams there. So let me tell you a little bit about us here. If you are new to learning about us, Bogart Wealth is a registered investment advisory firm. So what that means to you is that it's an independent advisory firm. We have about $3.1 billion in assets under management, a little under 1,400 households that we work with. So what does an IRA mean to you? It means that we are independent and we have a fiduciary responsibility to act in the best interest of you. And so what that means is that when we work with you, we learn more about what your situation is and help you make the best choices for what you and your family are wanting to achieve. We custody all of our assets at Charles Schwab. They are never held directly with us as well. We have 3 locations. I am mostly in the Houston office on Gessner, but I do go back and forth to the Woodlands office. And then, of course, our corporate headquarters is in McLean, Virginia. So for those of you who work with us, you know that planning is at the heart of what we do. I think a lot of the things that we're going to talk about today, just with interest rates and how to figure out how they're calculated with your pension, there's still decisions that you need to make as far as how do those affect you? What decisions do you make that's right for you and your family? And a lot of that really starts with that comprehensive planning to find out what strategy is best for you. Your interest rate decisions on your pension is specific to your goals, maybe not what your coworker is looking at doing or your neighbor is doing. So it's important for us to go through the planning process, figure out what it is that you're trying to achieve and how do we best achieve that and how do we make those decisions there. So we really feel very strongly about going through that planning. And that's going to change throughout your lifetime. So while you're accumulating money, you might have a different plan once you're getting ready for retirement, as well as when you are retired. Things can change as well, too. So we definitely want to make sure that you kind of review and keep your plan up to date as you go through the different stages of life as well. So we do have a few different what we call retirement readiness series that we put together. Retirement planning timelines. We'll talk a little bit about that here specifically to ExxonMobil. We'll do some retirement income planning, Social Security estate planning, NUA, backdoor Roth conversions. A lot of these you will receive invitations for. You can also go to our website on Bogart Wealth and watch the replays of these webinars as well. They're a great resource to be able to go back to learn more about. Sometimes you have to hear things a couple of times. And if there's anything else that you would like us to address, please let us know. We're always happy to make sure that we are giving content that is best suited for what people are wanting to see. So I want to talk really quickly. This doesn't necessarily pertain to the interest rates today, but I want to touch base a little bit since this is very top of mind for people with some of the new tax law changes that were brought into play with the One Big Beautiful Act that came in through over the summer. Highlight maybe just a few things just to keep at the top of your mind as we are getting into kind of we are in the fourth quarter and we do start to do some year-end tax planning for people and make some estimates. So for most individuals, obviously the tax brackets did not change. There are a few extra incentives with child tax credits. Individuals who are over age 65, there is an additional deduction that they are able to take above the line. There are phase outs to those as well. So they are not given out to everybody. The SALT deduction was increased to $40,000, again, subject to phase outs and limitations. So that is something that is new. The estate tax exemptions are going up to $15 million a person next year. And there are a few little above the line charitable giving donations that you can do as well too. So those are kind of four of the big key takeaways for people coming through that. So we just kind of like to address those with people. A lot of people have had questions on what impacts is coming out of that new tax bill. So if you have any further questions with those and how those specifically impact us, you can definitely let us know. So let's get started. So what we're going to talk about is the discount rates and specifically how they are impacting your ExxonMobil pension plan. We are going to be talking about the qualified portion of your pension. So individuals who have the APP, SPP, things of that nature, these do not go into those calculations. Those are going to be more set payouts that when you retire from Exxon, you don't get to pick those dates. So this is specifically going to be on the qualified part where you get to choose your election with that. So for most individuals now, everybody is under, kind of like the general rule for discount rates. For individuals who are grandfathered in previously, you have to be about 68 or older, still working at Exxon, to be under some of the old rules. So most people that we meet with nowadays are under the new current rules, which means there is the three different tiers for interest rates. So starting out with the general rule is that the rate that is in effect on your benefit commencement date is the rate that you get. Your benefit commencement date, or BCD that we like to call it, is always the first of the month. So let's say you retire today, October 8th. The earliest benefit commencement date you could have is November 1st. You can retire at the end of the month and your benefit commencement date can be the very next day as well too, but it's always going to be at the first of the month there. The original people who were grandfathered, they had the option to be able to choose what their current rates are, the day that they retire, or delay it until that next that month there. But we're kind of looking at the general rule. Most people are under that rule for now. So a lot of this really stems from that Pension Protection Act of 2006, which took effect in 2007. And so the big takeaway from that is it just started putting limits on companies and started setting some standards as far as what they had to be able to provide for these pensions. So it was showing that companies had to have an 80% funded pension plan in order to be able to offer that 100% lump sum option there. So they wanted to make sure that these pension plans are fully funded to continue to pay that. If their funding levels dropped, then they're required to put additional funds in there. This has never happened to ExxonMobil, but it was just more of a protection that was put into place there. It also defined what the discount rates that can be used. So this is what went from the government rates into the corporate bond rates, which was the biggest change for most people. It defined the actuarial tables that are used. Those do have to be updated every 10 years for the plan. ExxonMobil last updated theirs in 2018. So they still have a couple of years to be able to update those mortality tables. And then it had a few other things. Part of that with, after tax balances can go to a Roth IRA that's in a 401k, company matches, and raising some contribution limits as well in there. So specifically what it pertains to for interest rates on the lump sum pensions is it really changed what bond rates and yields that it's using. So it basically went from one of the one sole treasury rate to the 3 segmented corporate bond yields. And so we'll get into more details of what each one of those segments look like and how that impacts you and how that calculation is there. Again, we talked about it changed the mortality table having to be reevaluated for those pension calculations at least once every 10 years. They can choose to do it more often than that if they wanted to, but it did put that requirement on there. What we do want to see is a longer life is good when we're looking at these lump sum pension payments, and you'll see why as we kind of go through this presentation on what that cash flow looks like and how that impacts your lump sum pension amount. Again, we talked a little bit about this. This really came into effect. It took 5 years to come into effect. So in 2013 is really when all of these new rules started coming into play. So let's talk a little bit about where rates are and kind of get an idea for how the rates move. Like I said, there are 3 segmented rates that we look at when calculating the ExxonMobil lump sum pension. You can see that the greenish blue piece here, that's the segment 1. The blue is segment 2, and the orange is the 3rd. You can see that they typically move together, and that's usually what we see. Some will impact your pension amount in different ways, but typically we do see them moving all at the same pace. In 2020, when interest rates were coming down with the Fed during COVID, the first segment is much more impacted by what the Fed is doing. So as those rates were dropping very quickly, there was a really large impact on those segment 1 rates. But for most individuals, segment 2 and 3 are the ones that have the biggest impact on their interest rate calculations for that lump sum. And those are the ones that are definitely more geared toward more of the market outlook and what is happening. The segment 1 is very much attached to what the current Fed funds rate is there. I had a question that come in. I'll stop here and take this question that says, at the next mortality table update for ExxonMobil, which way do you expect it to move, longer or shorter life expectancies? From initially, some things that we have seen is that COVID changed some of the mortality tables for people and really shortened some of the life expectancies. Now that we are, 5 years past COVID, there haven't been any huge swings of showing how that has impacted long term. But initially, we did start to see life expectancies changing. The medical care has increased significantly, so it does prolong our life. So I think I don't know that those COVID tables might have as much of an impact on the mortality as we were initially thinking. But it definitely, I think, did change it a little bit there. So I don't think there's going to be any major changes within those, but there definitely could be potentially maybe a shortened life expectancy due to some of those variables that we've seen over the last couple of years for mortality. Okay, yeah. So we talked a little bit about those 3 and how they're moving here. So let's talk a little bit about the items that we just talked about the last slide and what those specific tables look like. Oh, another question came in. What is the age for the 2018 mortality? We'll talk a little bit about, you'll see some of those. It's in the 80s. That's there. It doesn't usually fluctuate too much. We're not talking about, going from like 85 to 90 or specifically 85 to 80. It usually is not swinging that much. It might just be a year or 2. That's off of there. Okay, so let's drill down a little bit on some of what the interest rates are and the biggest things that you need to know as an individual of how the interest rates are calculated. So keep in mind, when you were looking at interest rates, we know what the interest rates are currently trending at today. But when you go to make your ExxonMobil benefit commencement date pension election, they're going to look at 2 quarters previously. So one of the things to keep in mind is potentially looking at projections. That's one of the big things that we look at to say, where are we now? We can look back a little bit as far as where were they in the previous 2 quarters and what are we expecting right now based upon those current interest rate movements that we're seeing on a day-to-day basis. So in this example here, we have the current segmented rates for the third quarter of 2025. So what that means for an individual, so anybody who chose the benefit commencement date of the third quarter got the first quarter rates. So you can see January, February, and March. The first month of each quarter does not count. We will use that as an indication of where we think interest rates might be headed if we are looking at making some decisions, but they do not count towards the calculation. So it's just going to be those last 2 months of that quarter's interest rates there. And so we will break them down into segment 1, 2, and 3. And you can see there is a very large difference between what segment 1 and segment 2 and 3 will be. Remember, we talked about that curve there, that segment 1 is really what is impacted most by where the current short-term interest rate environments are. And segment 2 and 3 is a little bit more of an outlook and not as reactive to what is going on. So you can see where segment 1, 2, and 3 were for the first quarter of the year. Let's flash forward to where we're at right now. So we're in the fourth quarter of 2025. So we are looking back at the second quarter. So anybody who is choosing a retirement benefit commencement date of November 1st or December 1st right now, that's the two times that we have available left for the fourth quarter. They're looking back at these second quarter rates. Now, let's kind of do a flash forward for anybody who is potentially wanting to make an election for January or past that, or sometime in 2026, we pretty much have these numbers pretty solid. The September numbers, they're not confirmed by the IRS. They typically take about 2 or 3 weeks for the IRS to confirm what those numbers are, but they're published. But the IRS just puts kind of their stamp of approval on those as well. So you can see what the second quarter and the third quarter interest rates have been doing. We'll talk a little bit about kind of that combined number so you can get a better feel for it. But if you look at each segment here, you can see that there has been some significant movement in some of these, right? So segment 1, as the interest rates are coming down and the Fed has been lowering rates and the expectation is that they are lowering rates, that segment 1 has really been impacted by those drops. And then again, it does filter through a little bit with segment 2 and segment 3 as well, because they do agree that those interest rates do need to come down. So the economic outlook was still positive in the future for some lower interest rates. So when we look at this, somebody can, if they're retiring sometime in the fourth quarter, they could choose to say, you know what, the interest rates look a little more in my favor to go back to the third quarter. So I might want to look at my benefit commencement date of first quarter 2026, since it is going to be sensitive to what these interest rate changes are. What we want to keep in mind is that we want lower interest rates for a larger lump sum amount. That's what our goal is that we're looking at. For a period of time, we did have interest rates that were kind of stagnant. They weren't moving too much. So we didn't really worry too much about playing a little bit more of an interest rate game of when to elect our pension. But when we look at something like this, and I have somebody who's retiring, this is where the whole planning part of it comes into place, to say, if I'm retiring sometime in the fourth quarter, let's just say October or November, does it make sense for me to choose the December 1st benefit commencement date? Or should I defer that until January 1st, just to potentially get a little bit more of a lump sum amount there? So those are kind of some of the things that we talk through individuals in that situation to see what's in their best interest. One of the questions came in that said, which segment has the biggest impact on the lump sum? Typically, segment 2 and 3. We'll talk a little bit about why I said 2 and 3, because they do encompass a longer period of time. And it also does depend on how old you are when you go to retire. And I'll explain that a little bit more about the difference of the impact of segment 2 and 3 on somebody who's 55 versus 65 and how that is impacted on there. So one of the things to kind of think about is that if you're choosing the annuity is not impacted by interest rates. That's a separate conversation for individuals to have to figure out what is the best pension election for them. So the annuity is the annuity. That is not changing. That is just going to be based upon your age and your years of service. So the annuity is fully paid out at age 60 is when that is fully funded. So if you are retiring and you want to take the monthly annuity, it's not going to change. If you choose to delay that decision, if you choose to elect it early, you'll get a little bit of a discount. But at age 60, it is what it is, not going to be impacted what the current market conditions are or what the interest rates are doing. This is just going to be on those individuals who are taking the lump sum. With that being said, if you choose to have a little bit more of a hybrid strategy of a monthly annuity as well as a lump sum, you don't get to choose those independently of each other, right? So when you make an election, you are making an election on the whole pension. So we can't choose to say, you know what, interest rates look really good, so let me go ahead and take my lump sum and let me defer the monthly annuity part. No, we are making that decision together. So individuals who are doing a little bit more of a blend of those, we really just kind of have to say, okay, what's the best opportunity to kind of look at what we're doing to maximize maybe a little bit of the interest rate piece, but also looking at the annuity factor that is coming in as well. So one of the things that we do when you look at all of those different segment rates, it can be very difficult for an individual to say, okay, well, what does that look like blended? Because what happens is that segment one covers years basically 1 through 5 when you think of the mortality. So it covers 5 years worth of cash flow. Segment 2 covers years 6 through 20. So it's covering 15 years worth of cash flow. And then segment 3 is covering 21 and beyond. So again, when you think about how old you are, for some individuals, let's say they retire at 55, they're going to have more money in that segment 3 than somebody who's going to retire at 60 or 65. So for 55, segment 3 will have a bigger impact than it would on somebody who is a little bit older. So it is a combination really of segment 2 and 3, I think, for a lot of individuals, to answer your question, because segment 2 is so large when it encompasses 15 years. But if I look at somebody who's 55, segment 1 gets them to 60, segment 2 gets them to 80. They're not necessarily, that segment 3 piece is a little bit smaller for them based upon the mortality, but it could still be filling in another 8 to 10 years worth of that. But segment 2 for a lot of individuals will have the biggest piece of it that's there. And so you'll see in this chart here, there is a difference between segment 2 and 3 when you look at those rates there as well. So what we do for individuals to kind of look at this and say, okay, how do I put those 3 segments together for me individually and look at each quarter as far as electing my benefit commencement date? We do a calculation. We put them in what's called a single equivalent rate. So it's a really way to combine those on an internal rate of return is what we're looking at, and say, okay, how does that truly look for you? So in this situation, let's say somebody is 55 and they're looking at retiring, and they have the option to choose sometime between November and December or defer into the first quarter of next year. So if they were to choose a benefit commencement date in the fourth quarter, the interest rate equivalent is 5.64. If they choose to defer that pension or just retire, sometime where they can make an election in the first quarter, it's 5.38. So there is a reduction there. So remember what I said is that the lower the interest rate, the higher that lump sum amount is. So in this situation, if I have an individual who is retiring sometime in the fourth quarter, let's say they're leaving sometime in November, so they have the option to choose 12/1 or a January 1. And if it makes sense for them to go ahead and make an election, delaying that to 1/1 is going to give them more money on their lump sum pension part. Now, a lot of other things being said to making sure that that's the right decision for what they need to do, but potentially just a 30-day hold on that of delaying that decision by 30 days is going to give you a higher lump sum amount. Okay, when you look at those. So the same thing carries over depending on if you're 60, you're still going to see those interest rates drop again. Again, like we said, the internal rate of return changes a little bit depending on how old you are when you retire and you elect that. But in general, if we see this trend here going down, it's going to be the same that no matter what age you retire, whether it's 57, 58, or anything like that there. There is a question that says, what are the male versus female life expectancies currently in the mortality tables? I don't specifically know that specific table from ExxonMobil for the exact dates for that. I do know they're using the 2018 mortality tables. So I know that's the ones that they're using, but I don't know those specific numbers here. I know that our team calculates these in the background, and so they are looking at bringing in that 2018 mortality table, but I don't specifically know what that is exactly, or what the difference is between the male and female tables. If you want to send me a message, an email, you can definitely send me that, and I can have your contact information, and I can forward you some more information on some of those mortality tables there, with some specific questions on that. So one of the things to look at is kind of what the trend is with these interest rates here as well. There's a few more questions coming through here. Let me finish up this slide, and I'll get to these here. So when we look at where the trend of interest rates are, we are still in a low interest rate environment. I think coming out of 2008, when the market was lower, we kind of got in this mode of where we expected interest rates to stay low for a really long period of time, and we assumed that was the new normal, especially after COVID, when interest rates were coming down. We expected that to be the new normal. So even though we did see this spike, and interest rates are a little bit higher, they're still nowhere near where they used to be. Now, do we know why these yields have been substantially coming down, and what could specifically cause them to go back up? We really don't. There's not anything in here that specifically tells us why this trend is down. But when we saw this initial uptick here, and people initially were wondering, why are they so high? Yes, they're high, but just higher because of where we came through that period of time there too. So we are not thinking that they could continue to stay at this level given the downward trend of this. Let me go through a few questions here. So somebody says, if I retire at age 55 and withdraw the pension at 60, what interest rate will be used, and when do I need to make the decision? So when you make your pension election decision, as far as when you're choosing to take the money, that's the interest rates that you're going to be using. So if somebody retires at 55 and they choose to delay their pension, they can, at any period of time, as long as they get before age 65, they have to make a pension decision. They'll let you delay your decision until 65. So you can just leave it there. So you don't get that lump sum calculation or the annuity amount until you actually declare what you want your benefit commencement date to be. And benefit commencement date really is for purposes of electing your pension, right? And at that point in time, when you choose to elect your pension, that's when they're going to look at all of your information. So they're going to look at how old you are. If you're choosing the monthly annuity, they're going to look at your years of service. Those haven't changed once you've retired, obviously, but if somebody's making some projections on when to retire, those are still going into effect. But once you've retired, they're going to be looking at the current interest rates in that environment. So if I had somebody who retired at 55, and let's say now they're 58 right now, and they've continued to defer their pension, and if they wanted to elect a benefit commencement date, they're going to get whatever those interest rates are at that benefit commencement date. So if they elect it on January, they're going to get these rates that are here. So a lot of people deferred their pension, right or wrong. It was a decision that they made for their situation, and they wanted to play the interest rate game. If they retired a couple of years ago and interest rates were really high, and they thought, you know what, I want to be able to get a little bit more out of my lump sum, so I'm going to defer it and watch the interest rates. And so as the interest rates drop, then they can be getting a bump on those there. When do you need to make the decision as part of that? I would say definitely if you have retired and you are 60, at 60, typically the pension is kind of at its peak, especially for the annuity part is fully maxed out at 60. It's not going to grow past that. So you wouldn't want to defer that. And then from an interest rate perspective, it will start to go down because you're going to have less years of mortality. So past 60, we have to weigh those decisions on what makes the most sense if we still need to play the interest rate game, or at 60, if we were waiting for the interest rates to move and they hadn't moved, it's a conversation we need to have to see where the current environment is, to see if we still want to play that game. Because at that point at 60, if the pension is fully maxed, you're not going to be gaining anything more at that time there. Somebody asked, with women living longer, does that mean their lump sum is greater than men? You know, I don't think so. I think they're using a combined mortality table. Again, you can send me a message and I'll confirm that. I'm not an expert on the mortality tables, but I don't know that ExxonMobil is specifically, they may or may not be specifically looking at your gender to determine what that mortality table is there. Another question says, is the retired age 60 single rate the same if someone already retired but deferred lump sum until 60? Yes. That 55 and 60, those numbers are there. So it's not, again, a lot of the interest rates are not going to be based upon your retirement date. So one of the things that people have a confusion on is there's 3 terms that we'll typically use. There's your last date on the payroll, right? So your last day that you get a paycheck from ExxonMobil. Then there's a retirement date, and then there's a benefit commencement date, okay? So those 3 are not all the same, okay? But your retirement date and your benefit commencement date would be the same. But here's an instance where they're not. So let's say you retire, or your last day on the payroll is November 30th, okay? And then your retirement date is always the next day. So you last day on the payroll is November 30th. Your retirement date is December 1st, okay? It's the very next day after you were taken off the payroll. And then your benefit commencement date is when you elect the pension. So you may or may not be electing the pension on that retirement date of December 1st. Your benefit commencement date could be January 1st. Okay. So they're never all 3 the same, but the retirement date and the benefit commencement date could be the same. So when you think about deferring and kind of looking at these columns here, when we refer to those interest rates, we are specifically referring to that benefit commencement date piece of it, which is the first of the month within that quarter that you are electing your pension. That's what that is that we're looking at. So again, now somebody did say that if I retire at 60 and I defer, if you retire early prior to 60 and you choose to take your pension, there is a little bit of a discount rate that you get if you retire at 55 and choose to take your pension at 55 lump sum versus waiting until 60. So a lot of people will kind of look at that and say it's a 5% reduction year over those 5 years. So they'll commonly say you get a 25% reduction of your lump sum. So you should probably just wait until 60. It's not exactly 5% a year that you get added to your lump sum amount. It's a little bit more of an internal rate of return that goes into play, and it's about 3.5% or so every year. So some people will choose to retire at 55 and go ahead and take their lump sum pension, even though it's going to be a little bit discounted since they're not 60. Again, more of a personal decision, looking at the whole big picture and what they're going to choose to do with that lump sum. If you are going to take that lump sum and try to invest it over that period of time, you may or may not be able to do better than what that discount rate was that you took. Again, really depends on somebody's risk tolerance and what they're looking at doing. If I have a very conservative investor who is retiring prior to 60, and if they were to take the lump sum, they wouldn't necessarily be in a growth type of risk tolerance, they may want to continue to delay that lump sum option until 60 to where you do get that full portion of that. Another question says, by deferring, there's an interest rate play as well as the age discount factor, which is what I just addressed there, that yes, you're doing the interest rate factor as well as the discount rate that you get from taking it early from 60 there. Okay, so let's talk a little bit about kind of how you can see how these interest rate segments kind of start to play into how they impact you. So it's an internal calculation that A-Lite will do, or that anybody can do there, by basically taking what your annuity payment would be at age 60. Okay. So you can see that 76,711 here would be your interest rate, your annuity payment that you would get as a single life. And then what they do is they attach those segment rates here. So you can see here, we pulled in, if you're retiring in the fourth quarter, we are looking at the second quarter rates. So it shows segment 1 at 4.48, segment 2 at 5.51, and segment 3 at 6.14. So we put those rates in here. So this is where you can see segment 1 covers ages 60 to 64, 5 years. And then we get 15 years of segment 2. So there's the 5.51 going all the way through age 79. So we have 15 years there. And then we have, in this situation, the mortality table is to 83. So it looks like that might be what they are currently right now, is going to 83. And so you're only getting about 4 years worth of that segment 3. So in this situation, this is where segment 2 is definitely having one of the larger impacts here, because it is covering more of everything. So what we look at is we have to do this calculation of calculating the cash flow to get to the present value of that. So this is, I think, the easiest way to kind of understand how those segment rates can impact what that is there. And really, this cash flow here is just doing a cash flow analysis and coming back to a present value. Now, we purposely chose the 76,711 because we wanted the lump sum amount to be $1 million. And I'll show you why in the next screen. So that was all done by us. So you can see the impact of interest rate changes there. So it's really just the present value of the cash flow that you'd be receiving of your lifetime to get to that lump sum amount. So this is where you can see here that if you retire at 55, so this one here was retiring at 60. This is where your pension is fully maxed out. So again, we mentioned as well too, retiring benefit commencement date. This could be coinciding at the same time, but if somebody retired and elected their pension, or just elected their pension at 60, that's what this calculation is showing here. So if we flash forward a little bit to retiring at 55 and what that looks like. Now, we're using the same segment rates here, but this shows people the impact when you run your pension projections and somebody retires at 55 and they say, this is my lump sum today. If I take it now, or if I defer it 5 years until I'm 60, what does that look like here? So it can be a substantial reduction. So in that same situation, that lump sum amount is $801,000, right? So very different, because the annuity, we're using that annuity option because the annuity is a reduction, right? You're choosing to take that. So the annuity is reduced. And so we have to calculate the present value of those new cash flows if you were to take it at 55. So that's where that huge reduction comes into play on your lump sum there. So again, when we're evaluating what's going on here, it's very specific to say, it looks like if I waited 5 years, having $1 million versus taking $800,000 today looks like a no-brainer. It just depends on what would you do with the $800,000 if you took it today. Again, no guarantees in the market, but some people are willing to take that risk to say, just give me my money now and I'll go ahead and try to invest it. And by the age of 60, hopefully I can make up that difference. So those are the conversations to have and to figure out what your comfort level with risk is and what that looks like there as well too. Let's see, there's a question that says, if I'm considering retirement in the first or second quarter of 2026, is there a date that I should target as my last day on payroll where I would have visibility on second quarter rates to determine claiming first or second quarter? You do. So that's where we play a little bit of that game. So we will know, we somewhat have an indication. October's too early, right? We're only 8 days into October. So even though October doesn't count for fourth quarter rates, we will know when we finish up the month of October, we'll have potentially an indication, right, of where the October rates were. And then, of course, November and December do count. So we will know. They will not be finalized by the IRS tables, but you will know what those interest rates are when we have made those predictions So when January 1st rolls around, we kind of have a pretty good idea of what those fourth quarter interest rates look like, right? So if you're looking at going within the first or second quarter, keep in mind, remember, you can choose to leave at any point in time. It's just a matter of saying, what quarter am I going to get for interest rates? But if the fourth quarter jumps up, let's say if the fourth quarter rates jump up suddenly and you're like, the third quarter rates are more promising for me, then that means your last benefit commencement date could be March 1st, right? So you would need to be off the payroll February 28th, right? So last day on the payroll, February 28th, and you'd have a retirement date and benefit commencement date of March 1st. So that's the last day of the first quarter that you can elect a pension that would get third quarter rates. And then anything after that will have fourth quarter. So if we look at the projection that fourth quarter rates look like they're still going to continue to drop, which given everything that's going on, they should continue to drop as the Fed is lowering interest rates and the market does feel that the rates should be coming down. So if everything stays in the current pattern that's going on, then definitely the fourth quarter rates should be lower than third quarter. So that would give you, obviously you have visibility because like I said, we'll know as December wraps up, as you're in the first quarter to say, no, I want to get out of here where the interest rates have moved. I always caution people a little bit too of making some of those big decisions of retiring specifically, to lock in the interest rate because you're still working, they're paying your benefits, they're doing all of those kind of things that you're still getting. But if it is simply saying, look, I'm going to retire, I just need to pick the right quarter, then we will have visibility of whether or not you want to go in first or second quarter. And anything could happen to where fourth quarter rates could drastically drop or drastically go up, right? The market is a little bit all over the place right now. So anything could happen. But I do have a lot of people who are kind of in that window and they're just going to kind of play a little bit of that interest rate game. It does potentially we'll talk a little bit about the timeline of what happens with A-Lite. As long as A-Lite has your information, you can lock in for those benefit commencement dates. If they don't have that election done 35 days prior, so let's say you're playing that interest rate game, but we can't get our paperwork in to go ahead and elect a March 1st date, then it just means that you can lock in that interest rate. But if we didn't let them know 35 days prior that that's going to be my benefit commencement date, that means call it like mid-January, we're still not sure, then it just means they'll delay your pension payment for a month. You still get those rates, but you just will get a delayed pension a month later. So still works. You're still able to lock that in on there. Let's see. So another question around that was, so we'll have around 6 months or 2 quarters to decide the last day on payroll per the interest rate trend. I think I kind of explained that on there. So if you want to lock in the third quarter rates, right, which we will have confirmation within 2 weeks or so, but we know what they are. Those will be locked in. Then our last date on payroll would be that February 28th, and you have to elect a 3/1 benefit commencement date. Okay, because it has to be the first of the month, and that's the last month in the quarter. Okay, to be able to do that. So, and then the second quarter, the last day that you could elect within the second quarter to get the fourth quarter rates would be June 1st. Okay, so March 1st, June 1st is kind of where we're sitting for third and fourth quarter. So yes, depending on kind of 6 months, give or take where you're at on that timeline, we do have a pretty quick period of time to be able to do that. So this just really showed you the impact of potentially of taking the money early and the change within the interest rates here. So you can see here that third quarter, that third segment starts to come into play more so for somebody 55, right? In the previous one, we were only in it for about 4 years. And in here, we are in it from 75 to 82. So earlier with one of the questions of which segment plays the most into it, it's still going to be that segment too, right? Because you're still going to get those 15 years in there. But segment 3 does start to come into play if you are electing early at 55 for sure. Okay. So you can go in and people can calculate their own here if you have any questions on wanting to do this. But basically, I talked about this. You can go in and do an Excel spreadsheet and do a goal seek. For a lot of individuals, it's pretty easy to go online to A-Lite and do some pension projections on there and choosing some of those dates. But that's really all we're doing here for my Excel spreadsheet people who like to do all of that kind of stuff. So when we're looking at evaluating these interest rate calculations, to think about it in simple terms, I think is for every 1% change in that single equivalent rate, right, that we put together for people, whether it's 55 or 60, any 1% change impacts your lump sum amount by 10%. Okay. That is the way to quick math to say what's the impact of what's going on. Now, when the Fed is cutting interest rates 25 basis points here and there, does it naturally take 4 rate cuts for me to see that 1%? No, right? Because these are moving. You can look back and you can see where interest rates have potentially been moving more or less than those, because part of what's going on with interest rates, it's not just what the Fed's doing, right? Remember, that's the segment 1. Segment 2 and 3 are still more of the outlook and what's going on in the market. So it does have an impact of what they're doing, but it is going to be impacted of what's happening and how are those bond corporate yields moving out there and what's happening. So think of it that way. Every 1% gives you a 10% up or down. So if the interest rates are going to go up 1%, that would be a 10% reduction in your lump sum. If it goes up, it would be about a 10%. So for some people, this can be significant. If somebody has a $2 million pension, it's $200,000 change. So this is where we start going in and we're playing that interest rate game, right? Like this is where it becomes important because every little piece can mean 5 to 6 figures worth of additional dollars on collecting that pension. So one of the things that we wanted to show you here is a little bit of the impact potentially from that first example where I told you we wanted to push the $1 million lump sum out. I wanted to show you the impact of a slight deduction here within these interest rates. So this is where the interest rates were in the fourth quarter, right? So just if you're taking it in the fourth quarter, what those second quarter rates are, and then if we look back to kind of now, if we waited until January, what we're expecting some of the third quarter rates to come out, you can see. So segment 1 dropped, segment 2 dropped, and segment 3 dropped, right? So that $1 million pension is now $1,033,000. So again, depending on timing, how big is that difference by delaying it? That's what we're looking at there. If it's a 6-month delay, might be more than this. If it is up, by waiting 30 days. So in this situation, if I have somebody who's just going to delay it from December 1 to January 1 by waiting 30 days, they could get $33,000 more, right? So for a lot of individuals, they'll say, I don't mind waiting 30 days to be able to gain that there. So a little bit kind of further detail on when to consider delaying the pensions. We've talked a lot about these interest rates here. So that's option 3, right? Taking the lump sum because you're not taking the lump sum because you're expecting the interest rate to fall. Okay. That's obviously a very valid reason. Again, no guarantees, but that is a reason to continue to watch them and delay it. If you don't need the money right away. Now, again, depending on your age, different factors, depending on what your accessibility is to getting those funds without any kind of early withdrawal penalties there. Those lump sum payments typically do go into an IRA, and that does lock up the money till 59.5, but it also does give you that ability to say, I actually have access to it if you're older than that. So if you don't need it right away, you might have some options to continue to grow it to make up that difference, or just going ahead and letting the pension sit and play the game. And if you're retiring before 60, again, we talked about the numbers between age 55 and 60. What does that mean to you? Do I just, irrelevant of what's going on with interest rates, do I still just wait until 60 because I'm a conservative investor, I'm a growth investor? How far do I choose to delay? And you can make this decision at any given point in time, right? So when you go to retire, if you are not choosing to make an election on your pension, you do just let A-Lite know that I'm choosing to defer my pension choice. Previously, we didn't have to really let the pension group know. If you just didn't make an election, they assumed it was a deferral. But now ALITE does have an option when you go in to make your retirement selections. You do let them know that you are going to choose to either elect it, which then we pick a benefit commencement date, or you choose to defer it. And then that allows you at any point in time to be able to go back, as long as it's prior to age 65, and choose your benefit election. Okay. So again, a lot of this and the things that we talked about here is somewhat specific on picking the right dates, knowing when do I want to make these decisions, or when do I want to retire specifically from ExxonMobil. So one of the things that we'll do is we'll put together what we call a retirement roadmap that has different dates for people. So if somebody is choosing a certain retirement date, we'll put in their retirement date. So this is, assuming that they're going to be, they want a benefit commencement date of December 1st. And then we'll start to back into what that means as far as when do we need to get our paperwork in? What are the things that we need to get done through Voya as well as ALITE? And then, of course, once you have retired and elected your pension, what does that look like after that with what the choices are that you need to be able to do? I mostly tell people that are looking at retiring, there's two things that you really just need to do. Obviously, after you've notified your HR and your manager that you have a retirement date, putting that in, then that'll start the clock for everything else to start at ALITE. And so what that means is that'll open up the retirement portal for you to be able to continue to make your medical elections. So you want to make sure that you log in and make your medical elections so that you don't have a gap in coverage. And then that's where you do your pension election, whether it's a true electing at the time or a deferment at that time. So we walk you through all of that, make sure you get all of that kind of stuff taken care of. With ALITE, they do seem to be assigning representatives to people. So I highly encourage, if they don't offer you one, to get an assigned representative so that you can at least have somebody there in contact. So as we potentially need to make adjustments or things like that, or make sure your paperwork is in good order, to make sure that we get the dates that we want, that you have a point of contact there to get all of that taken care of. Just a little bit of different format here. The other one's the nice and pretty one. This one just kind of gives people all the specific details of everything on their timeline specifically there. So some of the things to kind of think about as we're looking at some of the interest rates, right? A lot of that does boil down to kind of having a plan, right? And figuring out what does it look like for you. Just because your coworker chose to retire and elect their pension, or chose to retire and defer their pension, doesn't necessarily mean that's the right choice for you. I am really big on just educating people on what their decisions are and talking them through that, so that when you do make these decisions, you feel very confident and comfortable with making those decisions, so that you don't walk away thinking, I wish I would have known this, or I regret doing this. These are irrevocable decisions, right? When you're making these lump sum payment decisions for people, or choosing the annuity option as well, irrevocable. So we definitely want to make sure that you've looked at your situation and said, okay, I've evaluated all of the options. This is my plan. How does the pension piece fit in, and what does that look like with elections? Past that, right? Part of that also is getting more detail into your retirement analysis, and creating a budget, and what does your cash flow look like, and what does your overall long-term risk profile look like? Again, I talked a little bit about whether or not you choose to take your pension at 55 as a lump sum, or you defer it until 60. I get a reduction if I take it at 55. Is it worth it? Right? That really depends on potentially some of your cash flow needs and your long-term risk profile on making those decisions there. So a lot of those things all come into play. It's not a decision of just interest rates, or I'm retiring today, and so I just elect it, right? So again, think a little bit more in detail about how one decision impacts all of the other ones there as well. Again, when you're working with an advisor, I think it's very important to have somebody who is discussing all these various strategies with you, provides that financial planning, and then gives you updates on that and kind of reviewing and monitoring it. Most people will go into retirement and they don't know 100% of what retirement is going to look like for them. So you want your plan to be flexible and give you some choices to make adjustments along the way. And you want it to be somebody who you, that you understand and enjoy talking to and creating this relationship. I think most individuals go into retirement if they have an advisor helping them. It's not somebody that you establish and you tell them your whole life of what your goals are, and then just saying 6 months later, I'm going to go to somebody else. So going into getting whatever type of relationship you want to get out of your advisor, I think is very important. Not everybody's right for everybody. It just depends on what you're looking for. But with that being said, I do think that you should have a certified financial planner who is looking at all the different aspects of this. I know we just talked about the interest rates, but when you think about that, it all comes down to, like I said, your risk and your cash flow and what your overall goal in life is. I know a lot of people seem to probably take 100% lump sum from ExxonMobil. I would say the greater percentage of people do, but it's not the right answer for everybody, right? If I have people who aren't wanting to leave a legacy behind or leave a sum of money behind to their family members, then maybe the lump sum part is not a big deal for them, right? Maybe they would like a little bit more guaranteed income, right? So somebody who kind of understands your plan, knows what you're doing and looking at all of the aspects of it, rather than just focusing on, I can grab this $2 million out of a pension plan and invest it for me, right? So those are kind of the things that you want to have in an advisor who's working with you on there. So if you don't already have an advisor here that you're working with, we'll have these one-on-one financial conversations with you. You can please feel free to reach out to myself if you like. You can find my contact information on the bogartwealth.com website. You can find my email if you already have an advisor that you're working with, or you can go on our website and see all of our advisors that are there. And so we would welcome you to be able to do that and create that relationship with us if that's something that you want to be able to do as well. Again, here's all of our contact information here with all of our different offices. We will do in-person, we do Zoom, we do phone calls, whatever works best for you as well. And we will repost this webinar if you wanted to be able to go through and hear more of those or see some of those slides in a couple of days. That should be posted to our website, along with all kinds of other material. We do have a specific ExxonMobil landing page as well that you can go into as one of the options and specifically look at the things that pertain just to ExxonMobil individuals as well. Again, we don't just work with ExxonMobil individuals, but we do have that specific page for people who just want to single out what your options are there. And so with that, I'm going to wrap up the official presentation. I don't see any more questions or things like that. So if anybody does have any more questions, please feel free to, I do see one more question that came through here. If you don't plan to sell ExxonMobil stock within 1 year, should we still use NUA? Everybody's situation is different, right? Not everybody should do NUA. NUA is a great strategy that's there if you have ExxonMobil within your Voya savings plan. So NUA is going to be very specific to your situation of whether or not you elect it, how much do you elect it, and what's the plan. Sometimes electing NUA helps to bridge the gap. Somebody retires at 55 and they don't want to access anything until 60 because it's all qualified. That could be a great bridge to be able to do that. That would require you potentially maybe to sell some ExxonMobil in the first year, but it could delay you to years 2, 3, and 4 potentially. Sometimes people do NUA as an estate planning strategy, so it has nothing to do with actually selling the stock. So it really just depends on whether or not you should exercise NUA. We'll do a specific NUA analysis. And again, it's part of learning about your plan and what your goals are to figure out, should you do it and how much should you do? So I'd be more than happy to talk specifics for you, or if you have an advisor here, talk to your advisor about NUA and how it fits in to your plan. I know a lot of advisors don't really talk about NUA. They're outside, Bogart Wealth. So it is something that not all advisors are familiar with doing, but we will definitely have a more one-on-one conversation with you for that. So happy to talk to you about more in detail if you want to reach out to myself or somebody else. So if there are any more questions, I don't see anything coming through. So again, thank you guys for joining. If there's anything else that we can help you with, we'd be more than happy to answer any additional follow-up questions that you might have about your situation. So with that, I hope everybody has a wonderful day and look forward to talking to some of you guys. Take care. Bye-bye.